Hi, I'm Justin Northcutt. I'm a commercial loan officer at Grow Financial, and today we'll be discussing commercial real estate loans. If you're a small business owner, at some point in your course of business, you'll probably need a commercial real estate loan. I'll cover the differences between owner-occupied loans and investment loans, talk a little bit about the SBA 504 program, and we'll also discuss risk, down payments, and some of the variables between lenders. In the business banking world, we have two types of commercial real estate loans, owner-occupied and investor or non-owner occupied. Both of these loans allow businesses to purchase real estate. The difference in commercial real estate loans comes down to two variables, where the repayment of the loan is coming from and who will occupy the property. With owner-occupied real estate, you're going to have your business that you own operating within the building. And so you will be occupying the space, and your business operating is what's going to pay the loan back. Think doctors, a lot of your manufacturing companies, dental practice, CPAs or attorneys, or really anybody in a single-use property that operates a business. Typically, this type of loan, think expansion. You're growing out of the current space you have, maybe you're leasing and moving out to your first property, or you need another location. All of those are great examples of owner-occupied real estate. Now, let's say you're looking for a property, but you plan to lease it, or you want rental income from the property. That would be considered investment or non-owner occupied, simply because the repayment of the loan is not tied to your operating a business. It comes from a third party. The differences between owner-occupied and investment comes down to really 51% occupancy. So if your business occupies 51% of the property and is operating out of that property, it can be considered owner-occupied. But if you're leasing out 51% of your building to third parties, people that you're going to sign long-term leases with, that's going to be considered investor real estate. A practical example of the differences in loans, think of an office building with 3 floors. If your business that you run occupies 2 of the 3 floors and you lease out 1 floor, that's considered owner-occupied because you occupy almost 70%. On the flip side, if you only operate out of 1 level and you lease out the other 2 floors, that would be investor real estate. Now that we've covered the basic 2 categories, let's talk about a loan option that we get a lot of questions about, the SBA 504 program. This is a government-backed loan program, and it's designed to help small business owners get their foot in the door to property ownership by reducing the burden of a down payment. It's a great program if you're looking to operate your business out of the space and are looking to keep your down payment as low as possible. One catch with the SBA 504 program is it is not designed for investor real estate. It is designed for owner-occupied commercial real estate. So now that we've discussed the 2 different types of loans and even the specialty financing with the SBA 504, one of the most frequently asked questions is, how much money do I need to put in the project? Or what is the down payment? Typically on an owner-occupied loan, you're looking at 20% is kind of a good example of how much you would need to put in. Meaning you would put 20% cash in the deal, the loan would be for 80%. When you're talking about investor real estate, your down payment might be as much as 25 or 30%, with the loan making up the rest of that. So why the differences in terms for these loans? It really comes down to risk to the financial institution. Owner-occupied loans are considered less risky than investment loans. What are the different variables that you may encounter, the different adjustments lenders can make, the things that borrowers should consider when they're looking to get a loan like this? Financial institutions can often vary on rate. They can vary on amortization, which is just simply how low your payment might be or how long it'll take to repay the loan. And lastly, fees. Financial institutions can control the number of fees and the amount of fees. Thanks for watching this video on commercial real estate financing. If you have any other questions, feel free to reach out. We're happy to help.